Hi, I'm Jimmy. In this video, I'm going to walk through my top 5 dividend stocks from the financial sector. This video is part of our Passive Income from Dividends series, where our goal is to find the top dividend stocks from each of the 11 sectors that can ultimately give us the passive income that we need to get closer to our goal of financial independence. There's a link in the description below to all of the other sector videos. Okay, so to make this top dividend stocks list, we created a few basic rules. First, they must have a current dividend yield above 2%. Then, they need a decent dividend coverage ratio, and ideally, they should be able to grow their dividend. Now, if you happen to know any other great dividend stocks from the financial sector, well, please let me know in the comments below. There's lots of them in this sector, so any ideas you have beyond the 5 that I mentioned, please, comments below. Now, most of the companies on this list actually trade in a few different countries, so you're likely to be able to find the dividend stocks that you're after wherever you live if you look around a bit for whatever countries you might have access to trading in. Okay, so let's jump into our first dividend stock. First up, JP Morgan, ticker symbol JPM. JP Morgan has a current dividend yield of about 2.6%. When we pull up their dividends per share chart, well, we can see that they've been quite steadily growing their dividends in recent years. And when we add earnings per share to this mix, well, we can see that JP Morgan has done a good job of covering their dividends in past years. And if we believe analyst estimates of the green bars, well, it looks like they're expecting for that to continue for at least the next few years. Okay, great. So I'm going to blow through some of these companies fairly quickly because I'm trying to get 5 companies in and I don't want to make the video too much longer and waste everybody's time. So if there's any of these companies that you think I should do a deeper dive on, I recognize I'm going through these fairly quickly. Any companies I should do a deeper dive, please put it in the comments below. Okay, next up we have Morgan Stanley, ticker symbol MS. Morgan Stanley has a current dividend yield of about 2.75%. And when we look at their dividend history, well, we can see that their dividend history has been growing nicely since about 2014. And it seems that analysts are expecting for that growth to continue over the next couple of years. Now, when we add earnings per share to this mix, well, we can see that they look like they're going to be able to continue to afford their dividends, which is a good thing for the sustainability of those dividends. Okay, moving along. Next up, we have Prudential, ticker symbol PRU. And that's a ticker, I believe, in both the US and in London. Now, Prudential has a dividend yield of a bit over 4%. And when we look at their earnings per share and their dividend chart, well, we can see that they've grown their dividend nicely in the past few years. And there's so much excess earnings per share that it seems like their dividend is more than safe right now. So unless something crazy happens, I expect their dividend to at least be maintained and probably increased over the next couple of years. Okay, next up we have Citigroup, ticker symbol C. Right now, Citigroup has a dividend yield of about 2.5%. And this is a chart of Citigroup's dividends and earnings per share going back the past few years. And although they didn't start picking up the growth of their dividend until about 2015, I know it looks like they actually didn't have a dividend before that. They did. It was 1 penny per quarter or 4 cents on an annual basis. That's why you see just a little dot there. Then they started picking up the growth of those dividends since then. And we can see with the profits that they can more than cover their dividend. So I wouldn't be surprised if their dividend continues to climb in the next few years. Okay, next up we have one of the more interesting, probably opportunistic, and definitely controversial companies on the list, Wells Fargo, ticker symbol WFC. Right now they have a dividend yield of a bit more than 3%. And the real opportunity behind Wells Fargo came out of their fake account scandal from 2016. This is a chart of Wells Fargo's dividend and adjusted earnings per share going back the past few years. And as we can see, their dividends look like they're starting to pick up pace again. And luckily, there's more than enough earnings per share to handle the volatility in profits over the past couple of years. Now, we may notice that down here, there's a dip in profits back in 2017. And this is at least partially from the aftermath of the fake account scandal. So for anyone unaware of what happened, about 3 years ago, it came out that Wells Fargo was creating, I believe it was something like 3.5 million fake credit card and bank accounts for customers without the customers knowing about it. Clearly, these are criminal actions. So the CEO ends up out of his job, and it's like 5,000, 5,300 some odd employees are also out of a job. Meanwhile, the Federal Reserve stepped in and put an asset cap of $2 trillion on the company until the company had better oversight and better make it less likely that this would happen again. They let go of their CEO, brought in another CEO. Let go of that CEO, so the third CEO is in. Many investors are saying that they're optimistic about the new CEO, who's Charlie Scharf, who he used to be the CEO of Visa. So the theory is that Charlie Scharf will be able to get the company back on course again. They can cut expenses, and they've already upped their dividend once. So many analysts are expecting for that continued increase in their dividend per share to happen at a faster rate than it was for a few years before that. Plus, there is an assumption that the customers who were going to leave Wells Fargo when the whole scandal happened, well, they probably already left. So perhaps the increase in dividends and the additional stock buybacks are enough to get investors back to the table, which should make their stock grow again, which hasn't grown in the past few years. Just to illustrate the stock buybacks that they've really increased recently, well, this is a chart of Wells Fargo's diluted shares outstanding going back to 2012. And we can see that they went from 4.8 billion shares in 2018 to just short of 4.4 billion shares in 2019. Now, I zoomed in here on this chart just so we could see the fact that they made bigger share buybacks in the most recent year. So please don't think that the shares outstanding got cut in half here. I just zoomed in so we could see it better. Now, I know that some investors don't like stock buybacks, and there's certainly a case to be made against them, but they're not all bad. In fact, I did a video on stock buybacks where I go through some of the pros and cons of stock buybacks in a bit more detail. That could be a good next video for you to watch if you're curious about it. There's a link here and there's a link in the description below. So I hope you found these companies interesting. I want to thank you for sticking with me all the way into the video. I really do appreciate it. Thanks, and hopefully I hear from you over in the buyback video. Thanks, I'll see you in the next video.